Hi, everybody. Good to see you tuning in again to the latest in our series of updates. This is specifically designed to talk about the upcoming earnings season in the US, which is, as always, very important and is sort of coming at a time where the macro noise in the market coming from the strength of the dollar and US interest rate rises and all the discussion about inflation is front and center. But later this week, we'll be starting the all-important earnings season. The Vermeer Global Fund has been positioned quite defensively with high levels of cash this year. Most of that cash is currently deployed in dollars. That's helped us absolutely. From a relative perspective, it's been unhelpful because obviously the weakness of things like the yen has been difficult. We would be thinking about the possibility of deploying some of that cash in this earnings season if stocks were unduly hit because they made cautious remarks about things like the supply chain or chip shortages or some temporary factors that might create an opportunity, for long-term investors to re-engage with some stocks now that valuations are looking a bit more attractive. So going into this season, Charlie, we've already had results, haven't we, from Nike, which reports slightly out of step with everyone else. And, Nike's a great company, executes well, is doing everything right from a perspective of the way it runs the business. But, what are your takeaways from those numbers and how we should be thinking about the earnings season going forward?
Yeah, I think it's, as always, it seems like every quarter we say this is an absolutely crucial earnings season, but I think this quarter really is the case, given where the market has pulled back to so far this year and the uncertainty around the outlook from a macro and a company perspective, from industrials all the way through to the consumer. But I think Nike is going to be a reasonable barometer as to what we're likely to hear from companies over the next month or so. In terms of the print from Nike, I thought was overall pretty solid, considering the backdrop of slowing consumer spending. I thought the numbers held up pretty well, all things considered. But the tone of cautious outlook and cautious commentary on the guide, given all the uncertainty, I think is a theme we're likely to see continue over earnings season. That numbers might hold up okay for Q2. But the commentary from management, I think, is going to be conservative and cautious, which I think is prudent. I don't think it's sensible for management teams to put out massively high expectations and high numbers, given the uncertainty in the back half of the year. So I think that's a theme we're going to see, along with we're probably going to see FX downgrades naturally because of where the dollar is, with the S&P majority proportion of earnings coming from outside the US, different from a small caps perspective, being more domestically focused. But I think that's the theme that we're going to see. Might be different from industry to industry, but we've got a good gearing as to what they're seeing on the consumer spending side, I think, which can be important read out the banks' results, which are first up in the next couple of days, isn't it?
That's right. So the banks are always the first to report, but actually couple of other companies that report early in the piece are things like Pepsi, which I'm sure the business, as always, is proving very resilient. What will be interesting, I think, to look into there is how much input pressure they are seeing, and is any of that starting to ease, whether that's logistics costs or input costs from raw materials, is any of that starting to abate? That will be very keenly watched, I think, by investors, and also their ability to pass on costs through price to consumers at a time where the consumers are tightening their belts. So they will be, I think, very interesting set of results. And in the industrial space, there's a company that we don't own, but we follow, and I think is a really well business called Fastenal, which is an industrial fasteners distributor to many, many industrial parts of the economy. And that's always, I think, a very good benchmark for what we're going to see from the reporting of industrial companies going in. So some very interesting early guides there. But as you see, the early days of the results season always dominated by banks. You have JP Morgan and their colourful chief executive, Jamie Dimon, giving us a real insight into what's happening in the economy, as well as a deep insight into what's actually happening at their own bank. So these things are very important. So, a lot to look forward to in terms of those results and how they're going to shape the results season in general. But, that's just really an aperitif, isn't it, Charlie? Because the real driver for markets, confidence and sentiment is still big tech and those dominant companies like Microsoft, Amazon, Meta, and Google, which is of course called Alphabet these days. How do you see those numbers shaping up, Charlie? Because they are so important to the market.
Yeah, as you say, they're massively important. And I think also before big tech reports in about 10 days or so, another interesting read on the switch between the goods and services side of the economy is the airlines tend to be reasonably early reports as well. We've got Delta Airlines, which reports also pretty soon, a sense as to how long they see this strong period in terms of demand to get on a plane. Again, it's always a question of whether the plane actually leaves or not at the moment. But we'll see a good sense as to what they're seeing on the outlook from the services side of things and travel spending from there. But as you say, big tech is going to be the key driver of where sentiment is going to go over this earnings season. And we're in extraordinary times, seeing who knows whether we're going to see big rises or big falls like we did in the last quarter, when you're seeing some of these mega cap tech stocks and $100+ billion companies moving in 40% increments on a daily basis on the back of the earnings prints that they put up. And I think it's going to be interesting to see how that all shakes out, because there are certain nuances you can pick up from each one, whether it's Netflix, who you could argue has got the big cut out of the way by getting it out of the way in Q1. We'll see what they're saying. They're always the first to go. And then you've got the businesses that are focused on advertising performance, businesses like Google, Alphabet, and Meta coming next, and also with Amazon, which is advertising is a big part of their business now. It's been growing incredibly fast. I mean, some of the data we've been looking at recently seems to suggest that so far retail advertisers and some of the advertising spend has held up okay so far in the second quarter. Big question marks over what that's going to do for the back half of the year. Amazon, I think, has come off an incredibly fast growth period for their ad business. So big now that they're declaring it within their results, as given their top line figures are so large, it gives you a sense of actually how big that business is now, and that they start to call out the numbers more specifically. So that's likely to slow from a very strong growth position. So, and I think the outlook from those companies is going to be incredibly important, because they see both sides of the equation. Amazon's seeing what the consumer's doing and spending. You're getting advertising spending as to what the businesses are thinking about demand for the back half of the year. So as you said, it's going to be hugely important to sentiment over the earnings season, and we'll just have to wait and see what they all put up.
Absolutely, and of course they are all very big international businesses, so the strength of the dollar will mechanically be leading to some pressure. And we've already had Microsoft, they shifted their consensus to reflect the strength of the dollar, and the dollar's strengthened even further since then. And actually, that's a really interesting point, because earnings have been sticking around the sort of mid 220s, high 220s for some time, and holding up well. And that seems mechanically a little bit difficult to maintain, doesn't it? Because we are going to see these dollar downgrades. I mean, we calculated, we thought it might be a 5 to 6% hit to earnings, which sort of implies, $10 to $12, something around that level. And actually, one of the strategists that we respect very highly, he's got an even bigger number than that. Maybe 8% hit, and perhaps he's factoring in some transactional impact companies, because US businesses are going to be less competitive against their sort of Japanese competitors or European competitors, because their currencies have been so weak. And that's a factor that we've still got to see play out. But I think, those downgrades, which are just translation reflected, will be looked through by the market to a large degree. It is much more the case that the cautious guidance that companies gave, and you referred to Nike, and obviously they were sensibly very cautious about what happens in Greater China because of ongoing lockdowns there. And that must be part of the commentary, particularly those businesses that are still very exposed to China, those that are very exposed to semiconductor shortages, high input costs, labor shortages. All these factors are going to be at play when companies put forward their results and put forward their future guidance. And it's likely to see, understandably, a high level of caution. Why wouldn't a CEO be cautious right now? So that, if things do play out quite difficultly, he can, highlight the fact that they cautioned against that. And if they don't, well, that they'll be pleased to be beating expectations. So, as you said, a very important results season coming up. We will be, following all our companies and some of the companies that are on our watch list, potentially to look to add to some positions if we think stocks get unduly hit, despite underlying the long-term prospects of the business being completely unchanged but seeing some short-term pressures from any number of the factors that we've talked about this morning. So with that, we'll leave it. Thank you very much for tuning in. We'll be updating on earnings and on our views on the ever-changing macro. Charlie, no doubt, will be updating us on his views on who's going to be the next Prime Minister at some point as well. So we'll talk about that. And as I say, we'll leave it there. Thank you very much for your time and look forward to speaking to you again soon. Thank you. Bye-bye.